Hey guys, welcome back to my channel. This is Sam, your favorite loan broker guy. Guys, I'm going to break down three variables, right? Let's talk about three individuals. Each individual makes $6,000 a month, right? So now one individual is the renter, one individual is a qualified home buyer, and the third one is I don't want to say worst case scenario, but let's just say this person really wants to buy a house and they're like failing passing grade of buying a home, right? And someone might say, well, if you're not there yet, why buy a house? Because that's what we hear on the internet, right? So let's break down these three individuals, right, guys? All right, guys. So now let's do the comparison, right, guys? Don't forget, three individuals. One is renting, two is owning a home, and everyone is going to move or leave in 4 years, right? We're just going to do a calculation of 4 years, right? So now we have the renter, apartment renter. The unit is $2,000 a month. Let's just say it's for 2 bedroom, right? I might even say 3, but 2 bedroom, right? And now the income requirement is 3 times the rent. So now you need to make $6,000 a month because that's what I'm evaluating. Like, I want to compare apples to apples, right? What you'll need is the first month's rent and security. That's giving you $4,000. You need a credit check and an eviction report because they want to know if you was a squatter or if you didn't pay, right? They're looking for these things. Now, paying $2,000 a month for a year, that runs you about $24,000, right, for the year. And in 4 years, that's $96,000 for the year, right? In 4 years. And don't forget, we're leaving. So we're leaving, moving out. You get your security deposit of $2,000 back, right, guys? Now, everyone knows this. Any renter knows that's what happens, right? Now, the next option. Here you have a homeowner, right? A qualified homeowner. And now when I say qualified, guys, I'm talking about qualified in the way of everybody else and not the Sam loan broker. Because guys, my channel is about information that you guys should know to benefit your pockets, yourself, and your financial future, right? So now we have, this is kind of 75% of people approval calculation, right? So just to simplify, we're going to have a home value of 400,000, right? And 10% down. Now, some of you might say, well, how did you came up with the 400,000? One, it's just a simple math that I'm doing, guys, just so I could break down these three individuals, right? So now a home going for 400,000. This borrower puts down 10%, which is 40,000, and today's interest rate is 6% rate, right? Now that gives you a monthly mortgage payment of $2,900. Now, what some people don't know, to get a FHA mortgage loan, or depending on the house you're getting or your qualification, it's 50% of your income. So if you make 6,000, that means you approve for a $3,000 mortgage. That's how I came up with that variable in order to get this house price, down payment, and interest rate, guys, right? So now this individual mortgage payments is $2,900. Now paying $2,900 for a year, that gives you $34,800. Now paying in 4 years, that gives you $139,200, right? Now, there's something called principal. There's something called interest and principal. Interest is what the bank gets, that goes in the bank pocket, and principal is what the homeowner gets. Now, let's look at it two ways. It's either going in a homeowner's pocket or to pay down the house value that they purchased. So you purchase $400,000, $1,000 of your $2,900 is going towards your home or your pockets, right? So in 1 year of principal, you're getting $12,000 a year back to you as principal. Now in 4 years, you're getting $48,000 in principal. Now you're ready to leave. You're ready to sell the house, right? Now you're getting your down payment back, $40,000. And a lot of people don't know, home values increase depending on what state you are or where in the state you are, guys. Home value increase anywhere from 2% to 6%. For luxurious homes, anything like over $800,000 or $2 million, those houses increase in value 8% to 12%. And this is like the normal, not everywhere. Because yes, you'll read the news. Oh, housing markets are down, values are down. That's for a different variable. That's not all homes. Anytime you hear that, that's not for 100% of the market. A lot of the news you hear, that's for like 25%, maybe less, right? So now, this home value that this homeowner bought goes up 4% in home value a year. So in 1 year, that gives you $16,000, guys. Now, in 4 years, that gives you $64,000. Now, there's something called local comp price, right? Local comp price, what is that saying is, if you own a home for $400,000 with three or four bedrooms, you know, same size kitchen, same size bedroom, one garage, most likely the 500 homeowners that have the same square footage as you. So let's, for comparison, you have a 22 square foot home, one garage, 3 bedrooms, one kitchen, small dining room, etc. Your comps in the area most likely is that home value. So if the next guy's paying 400, I'm paying 400. Now, what changes your home value is when a homeowner sells their house. As an example, I sell my house 400,000 and I say, you know what? Let's list it for 10,000 above asking price. So that's 410,000. What ended up happening to those other 500 homes is their value becomes 410,000. Now, guys, don't quote me. Take what I'm saying with a tablespoon of salt, not a grain of salt. Now, depending on the kitchen, the repairs, the maintenance needed. So most likely the house sold for 410,000. Now my house is worth 410,000. Another homeowner sold their house for 450,000. My house now is worth 450,000. So now let's look back on our list here underneath 4 years, right? So local comp price, 4 years, my home increased in value 40,000. Now, what does that mean? I total everything together, my 40,000, my 4% of my home value going up, which is 16,000 every year for 4 years, and the comps, I'm leaving with 192,000. Yeah. Now, let's do the third comparison. Third comparison is someone that didn't have 10% down, didn't have good credit, and barely meet the mortgage requirement. And for this, guess what happened? Mr. Bank or Mrs. Bank say, tell you what, everyone else is getting 6%, you're getting 7%, right? So now they're asking you to put either 0 or 1% down, right? So now let's do the evaluation. Home value, 400,000. You put 1% down, $4,000. Your interest rate is 7%, higher than the guy that's qualified with the mortgage algorithm. But tell you what, the bank is willing to give it to you, right? So now your mortgage payments is $3,500 a month, right? Yes, it's actually, what's that? $600 more than the person that had the 10% down, right? But we're going to charge that to the game because that's what happens when you put 1% and you're not qualified, or depending on the home you're getting, right? So now those payments of $3,500 a month for a year gives you $42,000. Now in 4 years, that gives you $168,000 that you're paying towards that mortgage, right? Now, don't forget your monthly principal, that goes back to your pocket or the home paying down. And in this example, we're selling the house in 4 years. So let's see what you get in 4 years. So your monthly principal, $1,000, just like the other guy. And then you're in 1 year, you're accumulating $12,000 in principal. And in 4 years, you accumulated $48,000 in principal. Now, you're leaving now. You're ready to go. Down payment, you get your down payment back, $4,000. Your home value went up 4%, just like your neighbors that have the same square footage as you, right? So now, in home value increasing, that gives me $16,000 a year. And in 4 years, that gives me $64,000 a year. And with the local comps, because individuals sold their house, which increased my home value, I got $40,000. Now I'm ready to leave, turning in my paperwork. What do I get when I leave? $152,000. So guys, what I just broke down is mortgage math. The renter is leaving with $4,000 in their pocket, and they spent their paycheck 4 years of $96,000. The $96,000 in 4 years as a renter, you're not getting back. What you're getting back is your security deposit of $2,000. Now, the individual that bought the house with 10% down, great credit, 6% interest rate, they're leaving with $192,000 in 4 years. Now, the next individual that if if you want to follow the internet, or if you want to follow other people, was like, what are you doing buying a house? Don't you know it's headache? What did this person get after 4 years? And 1% interest more, because interest rates at the time of filming this video was 6%. Because you really wanted a house so bad and the bank was willing to give it to you, they slapped on another 1%. So what did you get? You're actually paying $600 more than the qualified guy, and with no down payment, you're getting 1% interest more. But after 4 years, what did you leave with in your pocket? $152,000. So guys, whoever's on the internet telling you you should wait to buy a house, don't buy. Wait till interest rates go down. Every year you wait, home values go up anywhere from 2 to 6%. Besides the home value, comps go up, because every time a home gets sold, sellers, depending who, but they want to sell a little more than the actual value price. Why? Because homes actually go up. Homes is kind of like gold. It goes up. So guys, my video is here to break down, to educate you guys on why you should buy a home, or why you should buy a home now with a higher interest rate, guys. So I just broke down 3 variables. These are 3 individuals making $6,000 a month. And after 4 years, look how much everyone gets in their pocket. So anyone telling you, so don't buy a house, say, you know what? I'm going to try it Sam's way in mortgage math calculation to get ahead. Take care, guys. Look out for some more videos.